You don't get to 210,000 Twitter followers, nor to mention amass the kind of assets our next speaker has, without being very good at providing educational and entertaining content and also earning the satisfaction and trust of your clients. So I'd like to welcome Barry Ritholtz, CIO and Chairman of Ritholtz Wealth Management, up to the stage in a moment. For 25 years, Barry has been working at the intersection of behavioral finance and data analytics. His firm was launched in 2013 and now manages $3 billion in client assets. It was also named ETF Advisor of the Year and one of the Financial Times top 300 advisors. Regarding that content I referred to a minute ago, Barry has been named one of the 15 most important economic journalists in the US and has been called one of the 25 most dangerous people in financial media. Interesting title. I'm really excited to hear what Barry has to say. Please come on up to the stage.
Thank you so much. All right, thank you so much. I take no responsibilities for those various titles, but I am going to be the fly in the ointment today, and you can judge for yourself whether or not any of the stuff meets those accolades. So let me flesh out a little bit as to who I am and how I got that way. As said, I'm Chairman and Chief Investment Officer of Ritholtz Wealth Management. We run $3.1 billion for about 1,900 families. By the way, I will make this whole slide deck available for anyone who wants it, and my contact information will be on the last slide. So how did I get this way? I've been writing in public about markets and the economy and the decision-making process that human beings go through and why it is so subject to failure when it comes to things like money and financial decisions and risk-taking. And so I've been doing that starting in the 90s on Yahoo GeoCities, and then the Big Picture blog will be 20 years old this July, and I pretty much covered the entire world of finance and economics. I'm just setting my timer here. Finance and economics, and how we use data analytics to make better decisions to avoid our own foibles. In the mid-2000s, one of the things I started noticing was the increased securitization of subprime mortgages and how the economy was sort of backwards. Instead of a booming economy driving real estate, very low rates and booming real estate was driving the economy. And once you go down that rabbit hole, it becomes pretty clear pretty quickly that problems were happening. When you look back at previous financial crises that were based on excess leverage and easy debt, we see they all kind of end up in the same place. On average, real estate falls about 30% and stocks fall about 50%. And I was writing that in 07 and 08, and lo and behold, real estate fell 32% in the United States, about the same around the world. US stock market fell 56%. And I wrote all that up in a book called Bailout Nation that explained how the financial crisis happened and what we could do to avoid one in the future, which led to me writing the personal finance column in the Washington Post, and then Bloomberg Opinion, where I not only write there and at Business Week, but also host a podcast called Masters in Business that we're coming up on our 500th episode. It's the most fun I have all week. I get to interview people like Dick Thaler and Bose Weinstein and Ray Dalio and Howard Marks. And if you don't learn a little something from that, you're really not paying attention. So that's how I got to be who I am today. When I launched the firm with my partners back in 2013, they are similarly obsessed about why humans make the same bad decisions over and over again and what we can do to help it. My partner, Michael Batnick, is managing partner at Ritholtz Wealth Management. He's also number 2 on my investment committee, and he studied the best investors and their worst mistakes. Why do people like Warren Buffett make bad investment decisions? As it turns out, we're all subject to the same sort of errors. Ben Carlson runs our institutional side. He deals with foundations, pensions, family offices, endowments, and he is a student of financial scams. He spent the first half of his career working for a family office and was shocked at how much stuff he saw that was just pure junk. His most recent book is A History of Financial Scams. Finally, my partner, Josh Brown, is CEO of Ritholtz Wealth Management. He's on CNBC 3 or 4 times a week. His first book was Backstage Wall Street, where he revealed all the ways Wall Street separates you from your money because they know how to take advantage of problems with your wetware. You're wired to make these mistakes, and these salespeople know how to take advantage of it. And he revealed all the things he learned when he was on the sell side. So this sort of let's think about decision making and make better choices is really inherent in the DNA of our firm. And so today, based on that, we're going to talk about 3 things: how people destroy their own wealth, why we're so bad at making these financial decisions, and what it looks like if we engage in higher probability investing. Meaning there are no guarantees, but how could you put the odds on your side? So let's jump right into this. Really, these 3 things are what not to do, why we do it anyway, and what you can do to try and prevent it from happening. So I was talking to Joe Fitzgerald in The Money Show. We worked together about 18 years ago. And I had given a presentation here on behavioral finance a couple of years ago during the lockdown online. And we were talking about ideas for this presentation. And that next day, I read this article in the Financial Times about a very wealthy family in New York called the Belfers. Arthur Belfer fled Poland to escape from the Nazis during World War II. He comes to the United States and builds an energy company, which he basically turns into a very substantial oil company, and it gets bought for hundreds of millions of dollars. He's still a substantial shareholder. His son takes over, and he continues to expand that new company, which eventually gets bought by another company in the 1990s, which is the predecessor firm to Enron. And he ends up being on the board of directors. Fortunately, they diversified a little bit, but by the time Enron blew up, they lost $2 billion. And the family's takeaway was, hey, we're not so good at managing this money ourselves. Let's find somebody to give this money to. So they rolled out of what was left of Enron and put it with some guy named Bernie Madoff. And Bernie Madoff did the Bernie Madoff thing, and 6 or 7 years later, most of that money went poof. Although, to be fair, the special master who oversaw that bankruptcy did recover a substantial chunk of it. So I think the family said, the hell with all this stock stuff. This is just killing us. Let's rotate into something else. Let's go into crypto. And so they piled into FTX. And we know how that ended. So I call this the trifecta. The trifecta is you can lose money yourself, you could pay someone else to lose it for you, or you could give it to a con man who's going to steal it from you. This family, unfortunately, hit the trifecta. And if you avoid these 3 things, you will avoid 95% of the sort of losses that high net worth investors suffer. Yes, there are lots of other ways to destroy your wealth, but if you just skip these 3 things, you're ahead of most everybody else. So let's take a look at how some people have destroyed their wealth and what lessons we can pick up from that. Ways to lose your own money. So Bill Huang is really a fascinating guy. He graduates economics degree from UCLA, gets an MBA from Carnegie Mellon, starts working at Hyundai Securities when he's spotted by Julian Robertson, who runs Tiger Management, the giant fund of funds that has a whole bunch of hedge funds that have done, at least when Julian was alive, they did really, really well. They had a terrible 21 and 22, but so he goes to work at Tiger Management, sets up a fund for Julian, and is so successful that by the time he's fined by the SEC for insider trading and $44 million and kind of tossed out of the hedge fund business, he's amassed a few $billion of his own money. And so he very quietly launches his own fund, his own family office, which he calls Archegos Capital Management. And here's where things kind of get interesting. No one really knows because it's not, it's not a mutual fund, it's not a 40 Act fund, it's not a broker deal that has to register with the SEC, it's just family money. but the expectation is he launched with about $5 billion and embraced, instead of insider trading like he did at Tiger, he embraced leverage, about 5 to 1. So the good part about leverage is, hey, you have $100, you're leveraged up 5 to 1, you make 20 bucks, guess what? You just doubled your money. That's fantastic. The bad part about leverage, and I think you could see where this is going, if you're leveraged up 5 to 1 and you have $100 and you lose 20%, you're wiped out. You go to zero. At his peak, Huang was running about $100 billion worth of assets, of which he owned the underlying $20 billion. And in 2 days, he lost $20 billion. Speculation, leverage, concentration, all the usual mistakes he made. But that seems to be the most amount of money lost in the shortest period of time in recent history. If you're familiar with Evergrande, the guy who was chairman of it owned 60% of the firm, and he was an insider. He was well regarded by the Chinese Communist Party, and everybody was having a great time. He was worth about $50 billion. And then President Xi decided, hey, there's too much speculation in real estate in China, and so he cut off funding for that. And the bad news is he only lost 93% of his wealth, about $42 billion. The good news is he still owned a local Chinese soccer team and was building a battery plant when he lost the $42 billion. And then there's Elon Musk, who is the first person in history, even on an inflation-adjusted basis, to lose $200 billion in net worth. And that's not even talking about Twitter, which he paid $44 billion for, and I don't think you could sell it for half of that today. I think you'd have a hard time finding a buyer for Twitter. Don't feel too bad for Elon, because he's still worth about $200 billion between Tesla and SpaceX and other investments he's had. Elon is actually doing okay. But the fascinating thing is, here's a person who, is hyper-concentrated in a handful of positions, and the volatility there. Go back a few years ago, Tesla had a 10-year lead on every other car maker, and it was widely anticipated they would be added to the S&P 500, so everybody front ran the S&P 500 and added to this. At its peak, Tesla was worth $1 trillion, and that valuation kind of presumes that they were going to have like a 40% market share forever. And in the auto industry, that just doesn't happen anymore. And so not a big surprise this went down. So how can you destroy wealth? What have we seen from these three particular examples? And I could spend an hour on each one of these topics. I won't. Hyper leveraged. Some of these people used a ton of borrowed money. Concentrated risk. Instead of having a diversified portfolio, they have a handful of stocks. So if one stock really gets shellacked, you really feel it. They tried to pick stocks. It's really a thankless task. They tried to market time. We know how that worked out. They overtraded. They paid too much for things. And they speculated. The last three are my favorite because people are always surprised to see these here. So there are taxes, and then there are taxes. And when I talk about you shouldn't overpay taxes, I don't mean the Wesley Snipes go to jail for creating some tax twist that doesn't exist. What I'm referring to is following the IRS regulations so you pay the least amount of tax you are legally allowed to. And there are lots and lots of ways to do that. What we see very often are inherited tax, very low cost basis tax, founders stock, stock options that have appreciated dramatically. There are very simple and intelligent ways to work your way out of highly appreciated stock and have a minimal tax bill. You're going to pay Uncle Sam. He will get his pound of flesh, but there's no reason to give Uncle Sam 3 or 4 pounds of flesh. You could just follow the IRS rules and engage in certain types of trading setups that are very simple, perfectly legal, encouraged by the IRS. It's amazing people don't do this. Divorce. Sometimes I ask a room how many people are divorced, and about half the hands go up. And I won't embarrass anybody, but typically the people who are divorced are worth less financially than the people who are married. Last year we saw one of the biggest, most expensive divorces we've seen in a while. That was when Jeff Bezos separated from, Mackenzie Scott. That cost him $38 billion. And then Bill Gates said, hold my beer. And his divorce from Melinda cost him literally double that, $76 billion. So if you're going to be married, make sure you are choosing the right person. Otherwise, it's going to be expensive. And finally, people are surprised at death. But it's here for a reason. And let me just give you a little context, because I'm always shocked that people are surprised at this. You know, in any given year, the U.S. has about 3.4 million deaths. And in any given year, less than 2,000 people pay estate tax. Wait a minute, I've heard so much about estate tax. There's no reason to pay estate tax. 0.01% of households will pay an estate tax. The only reason to pay an estate tax is if you're on your way to your attorney to sign your will and you get hit by a bus. Other than that, you're just burning money. I don't know if you followed what happened with Prince, who died without a will, cost his family $100 million in just money paid to Uncle Sam. Between insurance and trust and philanthropy and just a handful of very simple planning, you don't have to pay estate tax, especially if you have less than $24 million, then there's no estate tax. But if you have a substantial amount of money where Uncle Sam might have their hand out, it's pretty easy to avoid that sort of situation. All right, so these are the 10 big ways to destroy wealth, and there's a ton to talk about each of them. I want to go back to giving money to other people to have them help lose you money. And let's see if we can just have a couple of quick examples, and then we'll get into why we make these mistakes and what we can do about it. So let's talk about the ARK Innovation ETF. Kathy Woods in 2020 was the hottest fund manager. No one was even in second place. The ARK ETF was up 168% from the year. Second place was like 103%. From the pandemic lows to the peak, she was up 220%. At its peak, she was worth something like, the fund was worth something like $39 billion. Here's the really crazy thing. The vast majority of the assets from that peak in the beginning of 2001, she added about $15 billion in assets. The fund is today only worth about $7 or $8 billion. Since the 2014 inception of ARK, 98% of the investors are underwater. That's an astonishing number. Everybody who's ever put a penny into ARK, 98% of the assets are underwater. By the way, I don't know who Christopher Bloomstrad is of Semper Augustus, but remind me never to piss this guy off. He's been tweeting about her. No opinion, just fact, and it's pretty brutal. So what about hedge funds? I don't want to go into ETF. Maybe we could go into a hedge fund. Well, they did pretty poorly in 2022. In fact, since the financial crisis in 08-09, they've been radically underperforming the S&P 500. If you look at that blue box on the right, that shows you the annual returns. Pretty mediocre. Jim Chanos of Kinnikos Associates founded a long-short hedge fund in the 80s. Probably the best known hedge fund. He's put up tremendous numbers over the years. And one of the interesting things he told me on Masters in Business actually was when he launched in the 80s, there were 500 hedge funds and all of them made money. All of them beat their benchmarks. Today, there are 14,000 hedge funds managing $3 trillion. And if you're not in the top 500, you're wasting your time, right? Hedge funds have become this massive wealth transfer money from naive investors to savvy fund managers. It's just math. It's just simple. You can't have that many people outperforming, right? I love asking people, how many people in the room are above average drivers? Everybody's hands go up. No, by definition, half of you are not going to be above, unless this is an F1 driving room, half of you are going to be below average, half of you are going to be above average. At least that's the statistics. You can't have 14,000 hedge funds running and gunning and outperforming. And as we've seen, especially with 2 and 20, it's a tough number to beat. And as we've seen over the years, hedge funds lost their edge Maybe it's dilution of talent. Now there's 14,000 instead of 500. Maybe the market's gotten more challenging. Maybe technology and computers and algos have made it harder. But whatever it is, unless you're really just looking for bragging rights, there's no reason to. If you could get into D.E. Shaw, if you could get into Saba Capital, if you get into any of those 500, by all means, have at it. Otherwise, come for the high fees, stay for the underperformance. So let's talk a little bit about expert opinion. These, by the way, are some fascinating people who have consistently been uber bearish despite the market going up over the past decade, not counting 22 or the first few months of 20. And you could read the details of these, but specifically, that's the wrong way to go. Up. Let me go back. So that's the chart of these guys. And it looks like Stockman got this right, except for the fact he's been saying the same thing since 2010, since around S&P 900, and just has been consistently bearish. The leader on expert opinion commentary is Wharton professor Philip Tetlock. He studied tens of thousands of forecasts from thousands and thousands of experts and found on average, experts are no better than members of the public. And there's some really fascinating data about this. First, an expert who gets, a forecaster who gets one big outlier correct tends to be more wrong for the rest of his career than the average forecaster. Why? They made a big call, they got it right, and now they want some more of that. And they're just, how often you get a major call like that right? It's very, very rare, almost random. And so they have a tendency to be wronger than the rest of their peers for the rest of their career. The fascinating thing is, no matter how right or wrong they are, what TV viewing audiences want is self-confidence. The more confident an expert is, the more likely a television audience is to view them as favorable, and the more likely they are to be wrong. You have two experts show up on financial TV, and one says, well, the future is inherently unknowable. There's so many random events that can take place between now and a year from now. No one predicted the pandemic. No one predicted the war in Ukraine. So forecast is folly, and let's just assume an 8% annual return, plus or minus 30%. Viewers hate that. It's accurate, it tells them nothing, and it scares them because it admits the future is inherently uncertain. Get used to it. On the other hand, the guy who comes out and says, Dow 42,753 is adored by viewers. Maybe they even give this guy his own show with sound effects and other fun things. But the viewing audience likes certainty. That's leadership. That's confidence. It's a giant money loser. So why do we make all these bad financial decisions? One of my favorite quotes comes from a physics professor that you may be familiar with, Richard Feynman. The first principle is that you must not fool yourself, and you are the easiest person for you to fool. Meaning it's very easy for us to fool ourselves into believing things that turn out to be expensive. Why is this? Why are we so easy to fool? Well, it's our wetware. Our brain is a marvelous invention that has succeeded in making us the dominant species on the planet. We are very adaptable. We find ways to adjust. We learn very quickly. The problem is we kind of learn a little too quickly. And the things that have kept us alive on the savannah don't help us figure out which municipal bond fund we should be investing in. So think about this. Your brain weighs 3 pounds. It's a tiny part of your body, but it consumes 20% of your daily calories. Why is that? Well, it means that your brain is not only is a key part of your decision-making apparatus, not the only part, but a key part, but it means that you have a built-in bias towards believing what you already believe. From the moment you're born, you start constructing a model of the universe around you, and you put time, energy, and calories into creating that model. And when facts come along that challenge that model, you are not happy. And so you tend to ignore that model, those facts that challenge that model, to your own detriment. So there are many, many ways that evolutionary baggage interferes with our investing. I've broken this into 3 big groups. Behavioral economics are just the things we could observe, just what we can witness in people's behavior, how they make decisions. Neurofinance is relatively new. It's the last 10 or 20 years, where we look inside people's perspective. We look inside what's going on in their body, their dopamine levels, their blood chemistry. We can use functional MRIs to see which parts of their brain lights up and actually figure out how they make specific decisions from what part of the brain, what is taking place on the inside. And finally, risk aversion is part of behavioral finance, and it just explains why we have a tendency to fear so many things and react in the ways that we do. We're afraid of shark attacks. We're afraid of terrorism. We're afraid of market crashes. What we really should be afraid, we should be less concerned with shark attacks and terrorism as individuals and more worried about our cholesterol and our blood pressure. Because what's more likely to kill you? It'll be heart disease, diabetes, cancer, high blood pressure. The odds of you being killed by a shark or a terrorist are worse than the odds of you being struck by lightning. And it's the same thing in the markets. Instead of worrying about our cost structure and our fees and our mistakes, we worry about market crashes. Hey, listen, market crashes are a feature, not a bug. They come along pretty regularly, and we see them on a regular basis. We should think about market crashes as an opportunity, not as a time to panic out. But this just reflects this. I love this chart because it just reflects the emotionality that is part and parcel of being a human being. Your flight or fight response is inherent in everything you do. And when the market's going up, everybody confuses a bull market with genius. And when the market is going down, we make terrible, terrible decisions and we panic. And a panicked primate flings feces, and in portfolio terms, it means you make a mistake that you often cannot recover from. So the Journal of Financial Data Science did a study, and they looked at how often investors freak out and what sort of behaviors they engage in. And people who panic sell into market crashes, the data point that blew my mind, almost 31% of investors who panic sell never return to risk assets. They don't buy stocks, they don't buy funds, they never return to the market. Stop and think about, if you panicked out in March '09, how much money you left on the table. And I was getting emails from people in 2010, 11, 12, hey, I panicked out, I didn't listen to you when you flipped bullish in March '09, what should I do? And the answer is, according to the math, put it all right back into the market today. According to human psychology, you're gonna have to break it up and parcel it in over the next 4 quarters, because emotionally, you put it all in and the market starts to draw down 5% and you'll go through the same process. So the behavioral mod around that is dollar cost average for a year. In 2/3 of the time, that's a worse performance than putting it all in, but it's something you could do with. You know, the perfect portfolio is not the one with the best returns. It's the one that you could live with. If you wake up in March 2009 and say, get me out of everything, that's the wrong portfolio for you. Your risk tolerance has to match your portfolio. So I didn't put this in the list because this is all related to so many of the other behavioral issues. It's a little bit of overconfidence tied to some really fascinating ideas. So David Dunning is a psychology professor at University of Michigan, and he did a study because he was curious about how good people were at evaluating their own skill sets, right? He did it with golf, he did it with finance, he did it with a number of different fields to see what the result was. And as it turns out, that your ability to metacognate, your ability to evaluate your own skill set is itself its own skill. Meaning, experts are really good at evaluating how good they are, and amateurs stink at it. And my favorite example is 2 golfers step up to the tee. They both hit the ball straight, 240 yards, lands right in the middle of the fairway, a foot apart. The amateur looks at it and says, this isn't that hard. Golf is easy. You just have to hit the ball straight and far. I'm great at this. The pro looks at where the ball lands and said, you know, I didn't swivel my hips until a second too late. I didn't keep my head down long enough. My follow-through was a little short. I should have brought my elbow around. Had I made those small changes, that could have been a 270-yard drive instead of a 240-yard drive. And that's the difference between an expert and an amateur. An expert understands where their skills are, and they know when they get lucky. Go back to that chart of Kathy Woods. The big complaint about her was, hey, is she skillful or is she lucky? Well, so far it looks like she was completely lucky. She had a lot of Bitcoin when it went up. She had a lot of Tesla when it went up. She had a lot of Amazon when it went up. All three of those crapped out over the next couple of years. She hasn't figured it out. She's still out talking about Bitcoin 1 million. Just on TV the other day, I was aghast. And not to pick on her. God bless her. She built a great firm. She has a great research department. They do really interesting things. I just personally have no interest in giving her any of my money. If I need kindling, I have some wood in my backyard that I certainly can light on fire instead of giving it to her. So back to Dunning-Kruger, when we compare the confidence degree with the competence, what's fascinating is we start knowing nothing and we get a little bit of a knowledge base and suddenly we think we know everything. And some people have called that Mount Stupid. That's the peak of Mount Stupid. You know a little more than nothing, and that's when people get into a lot of trouble. Once that collapses, once we hit that valley of despair, where you admit how little you actually know and how much there is to learn, that's where you start doing a little bit better. And you start to develop some competence and some expertise. So how can we put all this together with just a couple in the last 3 minutes I have and a couple of things you can do? Well, you can stack the odds in your favor with what we call higher probability investing. All right, let's talk a little bit about Hendrik Bessenmeyer, who's at the University of Arizona. I think it's the Carey School of Business. He studied 62,000 global common stocks over 1990 to 2018 on a compound total return basis. It turns out that 1% of stocks are responsible for the total return, net return of markets. That means some stocks do a little better, some stocks do a little worse, they cancel each other out. 1% of stocks are responsible for the entire gains of the market. In fact, 5 stocks, and you're familiar with FANG, it's Microsoft, Apple, Amazon, Google, and Facebook at the time he had done this, were responsible for 8% of those gains. So 1% responsible for all the gains, 5 stocks responsible for 8 gains. Which means if you're a stock picker, what are the odds that you're going to find that 1% of the 62,000? The odds are really stacked against you. Even if you get it right for a period of time, how are you going to stay right, as we've seen? So this led to a really interesting study at the King's College of London. They surveyed a few thousand funds and about 1,000 fund managers and said, how do you invest your own money? Do you eat your own cooking? And the answer was, most of them passively index. I'm going to say that again because it's so absurd. Most active fund managers passively index their own money. And finally, let's talk about time. These 4 are rolling 12, 20, 60, 120, and 240 month returns, meaning we don't care about the calendar year. The fact that the Earth has come back to where it started is not relevant to markets, but let's use these different periods. Rolling 1 year means January to January, February to February, March to March. It doesn't matter what the calendar is. Look at that disbursement. You could be up 53%, you could be down 37% in any rolling 12-month period over 1 year. Notice you get a little less red when you're looking at rolling 5 years. Almost no red when you're looking at rolling 10 years. And by the time you get to rolling 20 years, what you're talking about is a dispersion of between plus 0.5 and plus 13% on average over any 20-year period, which tells you that the high-frequency traders, unless you're running a computer algorithm where you're in and out in a millisecond, if you're flesh and bones, if you're a carbon-based life form, you shouldn't be doing that. You should be thinking about markets and asset classes in decades, not ticks or seconds or even weeks or months. And my last two charts, last two slides, what do you focus on? I'm always surprised when I have conversations with clients and say the questions that come up are always about the things that are not in their control. Markets go up and down. There's going to be inflation. The Fed is going to make a mistake. I was listening to George Gilder complaining about central banks. That's a given. Governments will make errors. Wars will happen. You can't control any of that. All of that is out of your control. What can you control? Well, you can control the amount of risk that's in your portfolio. You can control the amount of leverage you have. You can control what you consume in terms of media. You can control what you read, what you watch, what you listen to. Really, the thing that's in your control the most is your own behavior. And your own behavior is what's going to determine more than anything how well you do as an investor. Last chart is from JP Morgan Chase. I love this. This looked at a 20-year period ending in 2019, but we've seen this over other periods of time. It's always the same. Investors underperform their own investments, meaning investors buy stocks, investors buy bonds, they buy mutual funds, and they do worse than all of those, not because of the fees, but because of the way they trade, because of their timing. They find out about a fund like Cathie Wood's because it's become hot, and they buy after it's had a giant run-up, and then they panic sell out of it. Look at the 60-40 portfolio. Just buy a boring couple of indexes, couple of bond funds, couple of stock funds. You're going to get triple or double what the average person does. And really, the big takeaway on all of this is we have met the enemy and he is us. We are our own worst enemies when it comes to portfolio. If you can get your behavior in line, you're ahead of 98% of your peers. I don't care about stock picking or market timing, or if you want to have a 5% fund to trade, or you want to pull a little bit of money off for whatever, crypto, venture capital, private equity, it doesn't matter. But that's your fun money. Your real money has to be protected from you, who is probably the biggest enemy of your own net worth. And with that, if anyone wants a copy of this, it'll show up at ritholtz.com. You could tag me on email. Everything I've shown you comes from books, studies, academic research. If anyone is interested in anything, reach out, and I'm happy to discuss any of it. Do we have time for questions? All right, so who wants to ask about any of the nonsense I just shared with you? Do we need a mic? Click to exit. Did I just screw this all up? Yeah. Could you put the last slide back up on the screen? By the way, that guy you see with his hair up has been on the floor of the New York Stock Exchange for like 30 years. They always use him in media. It's always hilarious. All right, so let's start with some questions.
Yeah, thanks for sharing your knowledge. I agree with you 100% on everything you're talking. In fact, I want to even share a story that just fits perfectly. In 1987, I was victimized with the crash. And I was a young guy, and I also discovered options. And at the end of the day, I lost $27,000 at that time, single guy. That was a lot of money. And ever since then, for approximately maybe even 5 years, I never traded the market. Okay. And so now when I look back and reflect on it, I said, wow, you know, this just fits exactly in terms of the behavior that is kind of popular for situations like that. The other thing I want to say is that one thing that, you know, my wife, this is not true, but we'll just take an example of Tesla. So, you know, Tesla went down. If you look at the price of Tesla, you know, it went as low as the low 100s just recently, and then popped all the way up to
it's
around,
doubled from the lows, and
right.
It's still down 49% from the highs.
Right. But here's the point that's very interesting. So Goldman Sachs at the top, and this is not going to be accurate because I'm just putting some numbers, makes this recommendation that Tesla's going to be maybe 300 at some period or something like that. So it's not accurate, so don't quote me on it, but just for the example. So my wife comes to me and says, when Tesla's around 200. He says, hey, Goldman Sachs says, it's going to be 300 or something. Should I buy it? And I said to her, listen, dear, ask yourself this question. If it goes to 300 or whatever price, who's the idiot that wants to buy it? Would you buy it? Because you got to have a buyer for you to sell it. And she says, oh, you're making a good point. So
that fits right into your media consumption. Why do you care what Goldman Sachs says about Tesla? They're in the business of doing syndicate, underwriting, secondaries. They don't care about your wife's portfolio. They have a business to run.
Yeah.
So that points directly to, hey, be aware what you're consuming. We have time for one or two more questions, or let's get to the next question.
Hi, Barry. Thank you for your presentation today. I believe you mentioned at some point during the presentation that one of the lenses you look at or look through to look at the market is a technical analysis view.
Not technical, data analysis.
Okay.
Which arguably technical analysis can be fit into that rubric.
Right. Okay. So I was just curious to know, it seems like we're at a critical juncture here with the market. We're like on the verge of a breakout or potentially a retest of October lows. Do you have a short-term view and then maybe perhaps a longer-term view you could share with us on the market?
Yes, I do.
Thank you.
Oh, you want to know it? Oh. I just told you don't listen to experts. They don't know what the fuck they're talking about. Why do you care what my view is on the markets? So let me tell you the real problem with that and not just my view. Whatever I say could be the most accurate thing in the world. The second I walk out that door, it's stale. You don't know, Omicron 3 comes and half the country dies. Russia lobs a tactical nuke into... the world is so random. It's funny because I pulled it out of this because I wanted to keep it, under an hour. Whenever things get shaky on TV, they always trot people out to talk about, well, we're seeing an increase in uncertainty. And this will come back to your question. And whenever someone comes on TV to talk about, well, the world is more uncertain today than it ever has been, I always laugh because when the hell is the world ever certain, right? I can actually tell you in March 2009, everyone was certain markets were going to zero. And in late 99, everyone was certain trees wouldn't just grow to the sky. So certainty is a trait I want to be on the other side of. But uncertainty is the state of affairs. This is no great insight. The future is inherently uncertain. Period. Full stop. That is reality. When people come on TV and they start talking about uncertainty, what they're really telling you is they have gotten scared to hell and they can no longer lie to themselves. Remember, the easiest person to fool is yourself. They can no longer lie to themselves that they have an idea of what's coming in the future. My friend Morgan Housel is fond of pointing out that whenever there's a miss of earnings, the media reports it wrong. It's not that earnings missed estimates. The earnings are exactly what the earnings are. The estimates were wrong. And that just shows you how upside down our view of media consumption and thinking about investing and thinking about the future is. If we actually think that the earnings got it wrong and the analysts were right, we're doing something terribly wrong. So my view of the market is fairly constructive here, but then again, I'm always fairly constructive. Where the joke is where you stand is a function of where you sit. I run an asset management business. We're long only. I have an incentive for markets to go higher. So naturally, everything I see says, oh, look, the market's going to go up. That said, I'll put a little data on this so it's not just opinion. From 2010 to 2020, markets, 2010 through 2021, markets gained 14% a year. Long-term average is about 8%. So when I look at that decade, you don't know when that's going to end, but clearly there had to be some sort of reset, some sort of ability to say, hey, we've been wildly above average, and don't be surprised if we end up spending some time below average. So I don't look at 2022 as this annus horribilis, as everybody else seems to be. Equities were down 19%, unless you were have a little bit of a value bend, and then equities were down 10, 12%. Bonds were down about 16%. unless you shorten your duration and increase your quality, and then you were down about 10%. By the way, nothing, down 12% on equities, down 10% on bonds. Nothing to brag about, but certainly better than down, almost 20% in a balanced portfolio. I look at last year as just, hey, you just can't do 14% a year forever. You're going to need some sort of pullback. I don't see that. I hate the 20% number. It's such nonsense. You have 10 fingers and 10 toes. Has anybody ever seen a study that said, here's why 20% is so significant to markets? It's meaningless. It's a media-created myth. It means nothing. I look at bull markets as an economic expansion where people are willing to pay more and more for a dollar of earnings. So you have multiple expansion, rising corporate revenues, rising corporate profits. So far, that hasn't stopped. Yeah, you had a 19% drop last year, 30-something% on the NASDAQ. But to me, that looks more like 87 coming off of 82 than it does 08, 09, or 29 as we've seen the charts compare. So maybe this is the 6th or 7th year of inning of the bull market that started in 2013. Maybe it ended last year. Maybe it goes for another 6 or 7 years. The consumer continues to spend. We have, as much as we hate rates at 5.5%, 6% for mortgages, it's still below the rates that led to the financial crisis. So historically relatively cheap. Just recent period, it seems more expensive. The stock market's about a 15 PE. We don't look at any one variable. We look at the whole package. But it wouldn't surprise me to see markets go 5-6% a year for the next couple of years until the next mistake happens, whether it's a war or the Fed over-tightens or something. There's always something that comes along that we don't know about now. So I'm constructive, and as soon as everything hits the fan, I'll hide under my desk with everybody else. Any other questions? I think we're just about out of time. Go ahead, hit me. All right.
You talk a little bit about trying to maintain your composure and not panic selling and so on. I mean, I feel like we'd probably be better served if we had a psychiatrist or psychologist couch up here versus some of these chairs, right?
Right.
I look at my phone here, and just since you started talking, and maybe since this morning, I get more and more red arrows and red numbers and so on. And we all have these things. We're all chained to them. What do you recommend for the investors here, or when you're having a meeting with a client and they say they want to panic sell? What is the first thing you say to them, and what's the most important thing to keep in mind?
So first, before people become clients, we basically indoctrinate them. Markets go up and down. Here's the historical long-term returns. What are the odds that your emotional flight or fight or flight response here and now with this market red, what are the odds that you're going to get out? And then what are the odds that you're not going to be one of the 30% that never comes back into the market, and that's going to prevent you from being able to retire? So you have to, we call it purposeful capital. This isn't woke or anything. This is, you are investing towards a goal and an objective. So it could be generational wealth transfer. It could be paying for college, retirement, buying a house, whatever. It could be philanthropy. It doesn't matter what it is. That's your goal. How much risk do we have to take so that this pile of capital can meet that goal? And once you see that spread out on a Monte Carlo simulation, here's 95% of what's going to happen in the future. Look, we hit your goal 95 out of 100 times. None of those goals, none of that path involves panic selling. And that's usually enough to get people to say, well, what about the other 5%? Hey, it's that bus again. You can cross the street and get hit by a bus. You can't make anything 100% guaranteed. Risk and reward are two sides of the same coin. You don't get risk without taking some form of, you don't get reward without taking some form of risk. You just want them to be appropriate for those goals, for that purposeful capital.
Okay, perfect. And the other question I had that came to mind, especially when you're going through, this list of people who are obviously very accomplished, very wealthy, very intelligent individuals, Elon and the Belfer family and all that. Is there hope for the rest of us if this is happening to them?
Sure.
And why?
A listener of Masters in Business sent me something, and that kind of surprised me. And he said, you've interviewed 14 Nobel laureates and 22 billionaires. And the problem with being a billionaire, right? It's a sentence you don't hear very often. The problem with being a billionaire is that nobody tells you, no, you're wrong. Don't do that. What are you, an idiot? Do not buy Twitter. What are you, a fucking lunatic? Don't spend $44 billion on some piece of shit social media outlet. Figure out something. Just tweet. It's free. Nobody, a lot of these people don't have someone around them to just say no. Just say no. One of Mike Batnick is my colleague, and he told me my superpower is I talk to billionaires and Uber drivers the same, and I never really thought about it, but it's kind of true. And so part of the reason I can pick up the phone or bump into Mike Bloomberg or call Ray Dalio is they know I don't want anything from them, and hey, have you thought about this? So Elon needs some people around him that he's surrounded by yes men. Vladimir Putin, surrounded by yes men. You need people to say, by the way, Michael Batnick is the guy who walks in and says, what are you, an idiot? Delete that tweet. That's the dumbest thing I've ever seen. You need, and I'm not a billionaire, but you still need people around you who are going to tell you the truth and say, you are making a terrible mistake and here's why. And that's really important. Listen, Elon will be fine. He's worth $200 billion. SpaceX will go public one day. That'll be worth a couple of $100 billion. Tesla isn't going away. All right, so they had a 10-year lead. Now they have a 3-year lead. They're still way ahead of everybody else. It's still a cash cow. It's still more profitable than Ford and GM. I don't want people to think I'm just bashing Tesla. It's just had a massive run up and a massive rundown. And now he's only worth $200 billion. And, you know, it's tough out there for a billionaire. Right.
All right, one last question. It will be market related, then I swear I'll stop.
Okay.
I'll stop twisting your arm. You mentioned you're fairly sanguine, I guess is a good word to describe it, about the market environment, fairly positive. Is there anything out there, I mean, and especially after you give a talk, behavioral finance, not to be worried about these things or not to let your sort of fear instinct take over. Is there anything out there that does concern you, in this environment that maybe people should kind of keep in the back of their minds?
So that's a fair question. Here's the problem with it. We are wired to see threats, right? We are wired for existential problems to come up. Think about, I mentioned the evolutionary baggage. Go back a couple of 100,000 years, two guys are walking, and one of them sees threats everywhere. He sees a little motion in the grass, thinks it's a snake, he jumps, his friend laughs at him. He sees something in the woods, he goes away, thought it was a tiger. Eventually, the other guy gets eaten by something. And this guy, and that means he's not passing those genes along. So that's pop psychology of evolutionary theory, but it's pretty easy to see why we're wired for existential threats and why we ignore the positives. And this gets reflected in our media. If it leads, it bleeds is an old line. I'm trying to remember who wrote something about the Wright brothers. After the McCullough book came out, someone explained from the first time the Wright brothers flew that plane till they had done dozens and dozens of flights, it didn't warrant anything more than a paragraph 10 years later in the local paper, and it didn't get to the bigger papers for years and years. Arguably, flight has changed human society in the world as much as any other invention in the wheel, fire, the internet. Flight is up there with that. And so we just don't think about how these things are positives. But a plane goes down. I think 2019 was the safest year of flying in history. No commercial planes went down. Yeah. The next year, one plane went down and it's front page news. There are like 8,000 flights a day in the United States, and globally, you think about the math, it's pretty impressive. So I could tell you I'm concerned about Vladimir Putin. It'd be nice if one of the generals took him out, but that probably isn't going to happen with that 50-foot table of his. You could worry about climate change, you could worry about the Fed, you could worry about all these things. I can't affect them, so I would rather worry about things that I can control. So if you start focusing on those things, you're just not sleeping at night. You're staring at the ceiling, and there's always something to worry about. Another chart I didn't include with this, my colleague Michael Batnick created, called Reasons to Sell. And it's a chart of the past 30 years of the market just going straight up. And each quarter, he shows a different reason to sell stocks. And if you want to find something to stress about, there's endless things to worry about. But what can you do about it? There's really, so I'm old enough to remember the 70s and hyperinflation, and New York City was a dumpster fire. And then in the 80s, my whole life I've been hearing about the deficit and what a disaster this has been. My whole life, the dollar is going to collapse and no one will lend Uncle Sam money, and all these things to worry about all seem to fix themselves. At the end of humanity, that will be wrong. We'll eventually do something, we'll kill ourselves, and you could say, told you so. But I can't live my life in anticipation of that one colossal screw up where humanity ends. Eventually the sun will burn out. We got 7-8 billion years left. I don't think about that either, but it's coming.
Yeah.
So buy gold.
Perfect. Just promise me one thing. You won't let Michael Batnick be the one that actually tells Putin no, because, I assume you guys want to have a nice business relationship for a number of years.
He's Jiminy Cricket. He is my my conscience and the person who understands how things are going to be perceived better than anybody I know. So he keeps me on the straight and narrow, and he tells me no when I am off in the woods, like, dude, what are you doing? Just stop. All right. If Michael says stop, I better stop.
Perfect. All right, give Barry a round of applause. Great comment.
Thank you.
Thank you so much.